Hello and welcome to Aasgard Updates, episode number 2. This is the channel and show for us over here at Coldstream in the Aasgard division to talk to our investors in the Coldstream dividend growth strategies and the Aasgard small mid-cap fund. Happy to be here today. We're going to go over some charts, some of my favorite activities to look at. We're going to do good charts and bad charts. We're going to see if we can divine some patterns and see what's working this year and what's not, and I can share some of the tools I use to do that. A couple caveats first. This is not a solicitation for investment, and this certainly is not personal financial advice. If you need personal financial advice, reach out to one of our advisors and be happy to start up the relationship and discuss your financial situation. But nothing in here should be, in this video, should be construed as financial advice or a solicitation. So with that, let me change up my screen here. I'm going to do a new share. I'm going to take you to a website I actually found fairly recently, but I find quite fascinating because this is a piece of information I think is quite important to understand, just to know the landscape of the markets these days. And what you're looking at is a website, and I'll link it in the show notes here. It's sectorspider.com, and Spider is spelled S-P-D-R. This is a group of ETFs that break down the S&P 500 by sector. So you have different kinds of companies are in different kinds of categories, right? You have industrial companies are going to be in the industrials, and you have technology companies in the technology sector, and so on and so forth. And so there's communication sectors, and the consumer discretionary is a sector. And what this website has right here on the front page is the returns for each of these sectors over various timeframes. And so you can very quickly see what's working, what's not. And if you're a short-term trader, where the momentum might be, if you're going to go try to find those short-term opportunities, you'd be wanting to see the ones that are in the green and have a lot of momentum support. And we'll go look at some charts here in a second. And then also, if you're a value investor, like, where have people been fleeing from, and where likely are we going to find? Are we likely to find cheaper prices? And so you're going to look for the red categories here. And so you can quickly see here the pattern that we've seen year to date, that technology is up 24%, which is pretty remarkable given the global pandemic, the lockdowns, and the recession and the massive layoffs that we've seen. The S&P itself, as of today, it's August 14th, and the S&P is up about 4.42%, and we're knocking right on the door of an all-time new high. And you look a little bit deeper here, you see the communication sector and the consumer discretionary sector, both of which are, and I'll get into the largest weights in those indices are really kind of tech companies. In communications, it's Google and Facebook, which is obviously one trend of its own. And in consumer discretionary, it's Amazon, right? It's this big tech company that also has this enormous retail side, mail order retail side of it. And those are in the green, in double digits for the year. And then you get down here to energy. Energy is in a terrible bear market. It has been for, 3 to 5 years now. They've made no headway. There's basically a global glut of oil and fuel, and that has not helped the energy sector whatsoever. And then you layer in a recession and lower utility and usage of fuels and energy, you get a bear market. So again, if you're one of those value investors, this might be a great place to look for some value. Same thing with the financials. In this environment with the recession, the Federal Reserve has taken interest rates down dramatically, right? I mean, just the lack of economic activity can drive down rates, but the Fed explicitly has taken the Fed funds rate down to 0 and is running quantitative easing, which is essentially the printing of money to buy financial assets. Mainly they're buying bonds, and when they buy bonds, that reduces the interest rate on those bonds. So banks, on the other hand, they need spread, they need higher interest rates to make money. And without a lot of spread out there and without a lot of interest rate to play with, their earnings have been impacted, so they've been in a bear market. Well, I think this page is fascinating. On the right-hand side, you have you've got a list of the biggest appreciation stocks over the time frame. This is a year to date, and so you can see NVIDIA here is up 94% for the year. West Pharmaceuticals, PayPal, and it's basically everything on this list is in an enormous bull market and is basically hitting all-time new highs. There's a lot of momentum here. So again, if you're a momentum hunter, this is a fantastic place to start. I think it's a really nice, convenient website. You can even change the time frame here. You can get the last 3 months, you know, who are the biggest winners over the last 3 months, and 1 month, 1 day even, just to see kind of the shape of the market on a given day. So I'm going to flip this now. Share. Oh, no, on the same one here. Again, I'm doing all these things in a single take, so I'm going to make some mistakes. Bear with me. I don't want to spend my time in post-production editing these things. Anyway, this is the S&P 500. So this is, you know, people think the market is monolithic. Obviously, it's not. You go look at that last page. You know, there are various segments of the market that are doing very well, and there's segments of the market that are not doing well at all. And so this chart of the S&P 500 might not really tell you the full story of opportunity that's out there. There's going to be lots of, you know, opportunities underneath. Just go down a couple layers deeper. On the macro sense, though, the S&P 500 is approaching its all-time high as of February 19th. This is a pretty important inflection point. I'm personally quite nervous. When I look down deeper and see, you know, there's opportunity for this thing to grow because there's a lot of low-priced companies that can appreciate from here. My bigger concern is the tech companies that have rallied so strong and are all at all-time highs. Are they going to find further bids here? And so I'm a little worried that when we hit this old level that we're going to run out of momentum. Like literally you're going to run out of buyers that are enthusiastic to buy these stocks at these prices. Again, we'll go a couple layers deeper and see where that opportunity might come from. But I'm nervous. I've seen double tops before. We got a big double top before the 08 financial crisis, and we got a big double top right before the market really rolled over in March of 2000. And this is a giant double top. And so what we really want to see out of this chart going forward is that we definitively break out and we test this old high level as support. And right now, we don't have any evidence of that right now. We're literally just kind of stalling out here at the old high. The shape of the chart itself this is a pretty decent bull market chart. It is a bit stretched. What I mean by that term is the distance between the price level of the index or the stock relative to the average of the last 200 days. And you can see there's quite a lot of error between the two. Generally speaking, when that happens, and particularly if it's 50-day, you can get a retracement. And what you're looking for is support on those moving averages, and buyers will come in. And if buyers come in, that's a healthier market. And you can see this 50 days held up pretty well, basically since June, July period where the 200 held it up. But they're all pointed in the right direction. So this is still a bull market. And in a bull market, if you're a short-term trader, you want to buy these little dips and ride them to new highs before selling. You would do the opposite in a bear market. All right. So if you remember those sectors I just showed you, I took the 3 or 4 largest companies within each of those sectors, and then I made a chart list over here on stockcharts.com, and I will scroll through these pretty quickly. I don't want to spend all day doing this because I could talk about each of these companies for too long, but I do want to just kind of give a sense of what's happening under the hood of these various sectors. So here you got Apple, one of the largest companies in existence. I think it's over $1.5 trillion at this point. And again, this looks really stretched. The momentum is there. This is still a beautiful bull market chart, but I would be very afraid of buying this here at these prices. Again, if I was a short-term trader, if I saw a retracement, you got back down to those 50-day averages, that'd probably be a good entry on a company this strong, that has this much support. Obviously, their customers like them. They buy their products, and the company's prospects are continuing to improve, which is the kernel of truth that underlies that, appreciation like this. Here's American Tower. So this is one of the largest REITs in the real estate index. And so American Tower, they own the towers that when you're dialing on your cell phone and you go out there and it bounces off AT&T's tower out there. AT&T is leasing that tower, and it's leasing it from American Tower and a few other companies. And you can see usage is obviously going up. We are becoming more intensely electronic in our communications, particularly nowadays with shelter in place or just the stay at home and working remote phenomenon that's going on. And so these guys have been getting a big bid, despite the fact that we're in a recession. And so this is what, when you looking under the hood, you'd think real estate as an entity would be doing poorly given the recession. Retail is having a very, very tough time. The outlook for office is not very good, and the outlook for residential real estate, and particularly apartment rentals, isn't all that good because there's an eviction moratorium and many people can't pay rent simply because they're unemployed. So those segments of the real estate industry and those stocks are still down quite a bit, but there are segments like this one, tower, self-storage for some reason is still strong. People hang on to that, and in those kinds of segments are still doing quite well. Oh yeah, and data centers, which again, the electric, the internetification of our workforce is definitely supporting those businesses, and that's what's holding up the entire real estate index itself. Going down here, here's everyone's darling. This is Amazon, largest company in the world, and again, it's not as stretched relative to its 50 days. This is actually kind of better entry into what is the bull market chart of all bull market charts. There's nothing on this chart that would suggest that this company's going to have a rough time in the future. I'm going to do another call and another webinar on how to do valuation analysis. And so if you do a valuation on this company, they got a tough road to row if they're going to justify their current valuation. They basically need to grow their earnings at around 36% per annum for at least another 12 years to justify their current pricing. And I'll go into discounted cash flows and how you can arrive at that. But as a chart trader, this is still a viable chart. This is beautiful. They've actually paused here, which is good. You generally want to have some consolidation before making new highs. That's what's kind of scary about like Apple. We're just continually making new highs. Air products and chemicals, their input prices are going down and the economy is starting to heal and the dollar is getting weaker, and so their exports are going to start rising. And so this is definitely in the bull market category. It's come off its high a little bit. Again, see, when you get these little retracements, those are actually kind of buying opportunities in these bull market charts. And so this is a good looking chart. Poor Boeing, 737 MAX, and the lack of new purchase orders from airlines given COVID and the global lockdowns. Their stock price has been impaired quite heavily. This is a bear market chart. They fell off. They rallied up. They failed here in the June timeframe. They've gone down and they've actually violated their 50-day, and now they're hitting resistance at that 50-day. Not a good spot to be in. If I was trading the stock, this is where you would go short. And timing wise, I mean, if you want to be a contrarian, you can buy this, but I think it'll be a few years before this is a viable, good-looking chart again. I mean, look at the distance from its 200-day and everything. I mean, this is six to 9 months away from looking like a decent chart again. Bank of America, there's another kind of bear market chart. You can see that it has failed twice at its 200-day moving average. You can see these, you get these initial thrust up on, the relief rally as the economy started to open back up in June. It failed at 200-day as we started seeing case counts rising in Florida and Arizona and Texas. And again, it's failed here at this 200-day. The thing with the banks, these banks, they're going to make money. They're going to survive this thing, but it's going to be a few years at a minimum before we start seeing higher interest rates, right? The Fed has essentially messaged 0% interest rate all the way through 2022. I guess they could start changing their message. I mean, if things just were to magically start improving here, maybe by middle of next year, the Fed starts guiding that interest rates will start to rise in 2022. Then maybe you can start seeing some movement. But for the time being, these moving averages, this downward sloping 200-day, this is a nice target to where you would want to go short. This is not a viable chart at this point. And for super long patient investor, this might be a value investment you could pick up here at a bargain and hold it for 3+ years, and you might make some money. But in the short run, this certainly doesn't look good, and this chart probably can't improve itself for at least a few more months. Crown Castle is another tower operator in the real estate industry, and you can see that's a beautiful bull market chart. It's a little bit under its 50-day, 200-day, still solid and upward sloping. This might be a short-term trade right here that you might want to take on. One might want to take on. Not suggesting anyone actually trade these things. Just discussing it. All right, so Chevron, energy industry, terrible bear market, 50 days resistance, and it's sitting right at its 50 days. So again, another short candidate. Until we get oil supply constrained again in some fashion, and then further stronger economic growth, I don't expect much out of these companies. But they are cheap, valuation-wise. Utility companies haven't acted all that well this year. Part of that is because when you shut factories down, their biggest customers are not ordering energy, are not utilizing energy, and so their revenues are flat to down this year because of the recession. But I'm surprised that they're not performing better given how low interest rates. You can buy the utility index and get a 3.5% yield, dividend yield, taxed as dividend or you can buy a fully taxable treasury bond, 10-year treasury bond at 0.65%. I mean, it's almost a layup. Dividends on utility companies tend to be very, very stable over time. And so I'm actually a little surprised that these are not behaving better, because electrical demand is, despite the shutdowns, I mean, there may be another renewed shutdown, their revenues are extremely stable. Their earnings are relatively very stable because they're monopolies wherever they exist. And those dividends are, but they're by no means guaranteed, but they are incredibly stable. And so if you buy a basket of the utility companies, you're going to get, a cash flow that looks certainly a lot better than a bond does, with a reasonable degree of certainty that the yields are going to be there and the cash flows are going to be there. We haven't seen a lot of dividend cuts in utility land, despite the flattening of their revenues this year. Dow DuPont's breaking out again. Chemicals starting to break out here with the dollar declining and low oil prices. Duke Energy, again, another utility, not looking so good. Ecolab, this one's like a love it and hate it. We all have to wash our hands now a lot more. Cleanliness is obviously far more in demand, but the lack of people going into offices is definitely going to hit this, and the lack of restaurant patronage. You've seen declines in that. You've seen a decline in this stock. So it's a love it and hate it kind of stock. Not much information. I mean, just again, chart wise, not a lot of information here. Maybe you might use that 200 days of buying opportunity. Equinix, this is a data center REIT. Again, as everything goes on the cloud, these data center REITs have gotten quite the bid. These guys look terribly expensive, but this is a beautiful chart. This is the momentum trade. No one knows the music's going to stop, but the momentum is absolutely on the side of these. And so if you have to own real estate, this is like one of the few places that you can actually participate in the momentum. Facebook has shrugged off congressional inquiries and a boycott. But their stock's near all-time highs. This is a nice bull market chart. It's a little stretched here though. Likewise, Google, so they're going to be hurt because in a general recession, their customers, the advertisers, are going to be impaired. They might not have as much sales, so they might not be able to pay so much for advertisement. But their stock is holding up. It's still part of the tech trade. They have a small cloud business, but it's still all about retail advertising. Still holding up. This is a nice bull market chart sitting on its 50-day. That's probably a good entry here. Home Depot, this one's super stretched. I'd be very wary here. I know we're all locked inside, quarantine, but our only outlet is the home repair store. But there is a cycle of there is an uptick in new home sales and existing home sales. People are moving, and when they move, they go down to Home Depot and they buy stuff to fix things up. And so they've got a number of positive trends that are working in their favor. Although I would say, on a momentum basis, this thing is extremely stretched. I'd be taking profits here and be very reticent to be buying here. Maybe waiting for a decline down to that 50-day, which has been support back here in June, July. Industrials are starting to break out. This is kind of like the chemicals trade. As the dollar weakens, it makes our exports that much cheaper. And Honeywell is one of those. And so this is actually a pretty encouraging chart. When you break the trend, right? They've substantially broken their 200-day. You've got the upward sloping 50-day. They haven't done quite the golden cross thing yet, but that's a pretty good setup. And so what you're going to want to see is closes above this 165 level, which is where they failed last time. So probably not quite an opportunity yet, but you might want to watch that one. Johnson Johnson, looking pretty good. I mean, anything with hand washing related. JP Morgan, another bear market chart. This isn't looking all that hot. It's just another bank. I mean, one of the best banks out there. If you're super patient, you do a discounted cash flow analysis on this. This is a bargain. If you are patient and can wait out this recession and wait for higher interest rates, this is probably a good opportunity. Maybe you get another opportunity if it fails here at this 200-day, maybe you can pick some up, but this chart isn't good and it's unlikely to look good for a while. Coca-Cola, they've been hurt by restaurant sales. This is not a great chart. Again, it's failed a couple of times in this kind of like 49 level. It's 48, 45 right here, downward sloping 200-day. I would be hands off on this thing. MasterCard transactions. coming up on their old high. That old high would probably likely be a resistance, but you want to get an improvement on this 50-day. We'll probably see some consolidation here, but this is constructive. McDonald's constructive too. Here's your golden cross. We're coming up on the old highs of 215, which has failed twice before. That's a little scary. We'll see what happens there. Again, I probably wouldn't touch this until I got definitive breakouts over that old high, at least not as a buyer. 3M looking pretty good. Yeah, whole chemicals, materials starting to break out now as the economy starts to open back up. Merck, Microsoft is the most beautiful chart like in existence. It never gets too, well, I guess February is kind of extreme from its 200-day. Corrected going into the pandemic lockdowns, but you know, this 50-day has just been beautiful support the whole live long day, and here we are, we're right back at it again. 40-ish times earnings. It's pretty darn expensive with Microsoft. I've traded this at 12 times earnings before, not terribly long ago. So there's a lot of valuation there that could come out of this thing, but if you're just trading a chart, this is about as sexy as it gets. Next Energy, this is a utility company that ironically is doing well, breaking up. Newmont, a lot of people have been buying gold as the interest rates have fallen, real yields have fallen as a substitute holder of wealth. And then it gets its momentum of its own. This is a pretty good momentum chart here. Coming down on that 50-day, upward sloping, 200 is upward sloping. That might not be so bad. Again, this is a mining corporation. Netflix, this is pretty gorgeous too. This is, you know, watch this 50-day on Netflix. You know, we had blowout earnings and then it's come back down. This is probably a pretty good entry if you're going to do the whole momentum trade. You probably have a target price around that 550, 575 level if you're going to do a short-term trade. Nike breaking out. This is really cool. So you've got this big double top. You know, you got your January, what is it, June, July, and now we've closed above it. And we're holding there. That's actually a pretty good spot. That would be a pretty good entry on what looks like a very nice bull market chart. Pepsi looking pretty good. Staples. Pfizer, not much of a chart there. Big dividend yield though. Procter & Gamble breaking out, again, household products. Prologis, this thing basically just tracks global commerce. As Europe and Japan and China are opening back up, this thing's gonna start taking off. This is a real estate investment trust that owns logistics centers. United Health, another beautiful bull market chart, a little stretched here. Union Pacific, again, that whole global trade story is going on, and we're basically coming out of recession, so they're getting a bid. And again, we're closing at new all-time highs here, but consolidating, that's generally, you know, pretty good positioning to buy in, despite the fact that it's run so far. Visa hasn't closed above its old highs. Again, Visa's going to run like MasterCard. It's just transaction count as the economy recovers. But this is one of the best bull market charts that you're going to find. This in Microsoft, and so it's basically at its 50-day right here and holding. So that's pretty cool. Walmart, one of the only essential businesses allowed to stay open. So one of the businesses that are allowed to stay open, all the small businesses can't, but hey, if you're Walmart, you get to write your own rules. Big, beautiful bull market for them. Exxon, same thing as like Chevron, energy sector, still a bear market. All right, so I think, the way I would characterize all this and kind of sum it up is like, tech looks like a bubble. Certainly is a momentum trade. And so if you're a momentum trader, there's a lot of momentum to chase. There's a lot of good companies that are basically sitting right on their momentum channels, and you can probably pick those up. As a fundamentalist, like as someone who believes that valuation, looking under the hood of a company, cash flows drive earnings and earnings drive stock price over longer periods of time. That is fundamental to how I think about money and how I invest. We've got a big mismatch in the market of what's being rewarded. We have companies that have very little earnings that maybe have fast revenue growth, but maybe not so much cash flow. that are skyrocketing in price, and people are just so super enthusiastic about it, and they don't want to miss out. And so I understand that you can chase that, and that could be a good trading strategy. But that usually ends in tears and sadness and anguish. You know, if you get a 1999 again, and that will eventually happen. Don't know what the catalyst will be, but it'll happen. And at the end of the day, companies that have strong, durable balance sheets and loyal customers that drive, and are prudently managed and drive earnings, those companies are going to win out. And there's a lot of bargains out there. And so, hopefully going through some of these charts, you can see some of the patterns there, right? There's definitely a momentum trade, but on the other side of the momentum trade is a value trade. And there's a lot of opportunity for a patient investor to find strong, durable companies at very reasonable prices. But I find this chart stuff really fun. I mean, it's the least value add that I can give in their strategies, but it's also one of the most entertaining bits. And so I enjoy doing this, and I'll do more of these in the future. I mean, because it's always dynamic, it's always changing. If you like what I'm sharing, give me a thumbs up, and then maybe subscribe and watch more of it. And if you have any comments or questions, anything that you want me to address, please throw it down there below, and I'll look forward to speaking with you next time.